Welcome to the first of Money Smart Week 2013 programs at the Iowa City Public Library. My name is Maeve Clark, and I am the Adult Services Coordinator here at the library. And we are very, very pleased today to have Dave Oppedahl. Excellent, I got it right. Dave Oppedahl, who is coming to us from the Chicago Federal Reserve. And thank you to the Chicago Federal Reserve, Federal Reserve Bank of Chicago, for allowing Dave to travel to Iowa City. And it sounds like he's been traveling all over the state in not so nice weather, and today he brought us beautiful weather. So thank you very much, Dave, and the Federal Reserve Bank of Chicago. So we have another program tomorrow at noon, and I just found out lunch will be provided. So if you're watching from home and you'd like to come down and participate in the program, I think it'll be a really good one. It's put on by Bank of the West, and we have 3 presenters for that. But today's program is from Dave's point of view, and it is all about the financial climate right now. Dave he directs the Chicago Federal Reserve District Survey of Agricultural Banks on agricultural land values and credit conditions, and publishes the results in the Ag Letter, Chicago Fed's quarterly agricultural publication. But he will be talking today about more than just the agricultural community. So without further ado, I will turn this over to Dave. Thank you very much.
Thank you. Well, good afternoon. I'm glad to be here in Iowa City and doing a little bit of a trip across Iowa in various locations as part of Money Smart Week. We're happy from the Chicago Fed to be able to sponsor this and to help provide some of the resources and leadership. And so I hope to give you a better feel today on what's happening for small business in the United States, and basically thinking about where the economy is headed and how that impacts us in the middle part of the country. One of the ways I like to start is to think about the overall economy from many different perspectives. When you think about the economy, you can see here it's a little bright in the room, but we're going to have the lights adjusted. And so you can see here in the chart that there are many periods where the economy really can fall dramatically, and those are the recessions there in the kind of the gray bars. And this number is designed based on hundreds of other data that are crunched together in a program, and it creates a national activity index. And the best way to think about it is when you have the really low numbers, those indicate the recessions, obviously, and then numbers above zero indicate growth that's above trend, that we have growth in the economy that's quite strong. And then the most interesting area to follow is that kind of in-between area where, like from 0 down to -1, those numbers are indicating that we are having growth, but it's pretty slow, it's maybe hesitant, and so that's really where we've been for the past few years. After the very deep recession, you can see that we have been bouncing around with some growth, but it's below trend and it's not as strong as we would like. So that's been a major factor in our thinking about what's been happening in the economy, that we really are in that kind of period where it's not very strong, and so we're not worried about getting into the above zero category where you start to think that inflation is a real problem. We're still more kind of in that period where unemployment is the issue that we're more worried about, and that's coming out of a deep recession, and we'll look at some of those factors in a minute. But I wanted to highlight what the Federal Reserve's approach to dealing with these kinds of downturns is, and that involves monetary policy, and our primary instrument has been that the Federal Open Market Committee will raise and lower the target rate for Fed funds. And you can see here that it was rising in the period before the recession. As economic activity is growing, we would raise interest rates a little bit to try to keep a little damper on getting out of having it grow too quickly. Kind of like if you have a gas pedal, you put and the brake pedal, you kind of hit the brakes a little bit when the economy is growing quickly. But then once the recession hit in 2007, 2008, we started to lower those target rates very quickly, because at that point you need to hit the gas, because you need to help the economy to move ahead. And what ended up happening is, as you can see in this chart, the interest rate targets got so low, down to almost 0%, that they couldn't go any lower. So during the recession, here we are trying to fight a downturn in the economy, and our primary tool is one that we can't go any lower with. And so we ended up having a period in conjunction with the financial crisis where many special programs had to be put in place. And so quantitative easing was instituted, and you can see from this chart that there are many very unusual programs that were instituted during that financial crisis where we had to help with particular subcategories of financial markets or particular companies, even like AIG, that were about to go under. So we had a lot of unusual things during that period, but the key point to, is that those have shrunk over time and have pretty much gone away at this point. But there has been something that has continued, and that is our security purchases. So we've added more mortgage-backed securities and other kinds of treasuries that have been growing our balance sheet. So now you've had additional periods of quantitative easing to help stimulate the economy even further. QE2 is kind of in that period, and then there was a kind of a period called Operation Twist where we were rebalancing our portfolio to try to have longer term securities in place instead of some of the shorter term ones. And then finally now in the last little bit here, we've moved into a new period of quantitative easing that I'll talk about more in the end. But since the economy really hasn't started growing as quickly as we would have liked by this point of a recovery, we've continued to have some additional quantitative easing. So when you think about that inflation part first, that's one of our two primary goals at the Federal Reserve in monetary policy, is to have low and stable inflation, and of course the other is to have a high level of employment. And when you think about the food prices and other kinds of more volatile costs that are in the economy, we tend to focus on kind of the yellow line here. This is the core, kind of what we would think about as medium run inflation, kind of one of the better predictors of where we're going to be in a year or two. And so you can see from these lines that most recently inflation's been running around 2%, and food inflation actually was a little under that at this current time, but it's more variable. So a couple of years ago it was well above, getting up into the 6% range, and then it was down where food prices actually shrank for a little bit. But certainly that kind of volatility is something that the core doesn't take into account as much, and so that's just one measure that we look at for inflation, and we want to look at a lot of different measures. And here you can see that last year's drought was one of the things that's kind of interesting to follow, because a lot of people were predicting very high food prices after that, and you heard a lot of talk about that a year ago. And so it was interesting that certainly there were higher food prices in some areas. In particular, you look at corn and soybean prices in this chart, and they were higher. But at the same time, when you adjust for inflation and look back to the 1970s, we had even higher prices. So it's not like the corn and soybean prices were so dramatically higher that it really skewed the consumer prices for food. And it's interesting to think about when you spend that dollar on food at the store, what's that composed of? Well, the farm part is only about 15 cents of that dollar. And so there's a lot of other activity that's going on, whether it's the labor that goes into the manufacturing, the transportation, the marketing. Almost all of our food dollar is some of these other activities after the farm. So really, there wasn't a huge rise in food prices at that time, partly because of that kind of effect where it shrinks down the actual impact on the dollar we spend on food. On the other hand, energy prices have been a bit more of a problem for consumer spending, and you think about what happens when you buy gasoline. Now, I left Chicago, it was over $4 a gallon, and so that is very high right now. But it also has seen higher periods, like a few years ago in 2007, and also back in 1980 when you adjust for inflation. So these are high prices for our gas and oil in particular, but at the same time, they aren't tending to increase at the moment. For oil, there's been a lot of new sources of oil found in the United States with the new kinds of drilling techniques, and that's been something that has helped to lower the price in the United States relative to the world level, although gasoline is a little bit more on the world market because we can export that, whereas crude oil we don't at the moment. So when you think about energy, there are rising energy costs in some areas, but then also there have been lower costs for natural gas, for instance. You look at the industry in the United States, and for businesses, their inputs of energy, it's been variable. It's up in very big spikes at times for natural gas, but now with, like I mentioned, for oil, there's a lot of new sources for natural gas in the United States, and our production has risen quite a bit, and that's helped to keep natural gas prices lower. So overall, when you look at inflation, there are these variable components that have been higher and have spiked up at times, but overall, inflation is pretty contained. It's around 2% from the Consumer Price Index, a little lower when you look at some of the other indices, but certainly nothing that's concerning at the moment for the Federal Reserve, and in particular, the forecasts, these according to the blue chip CPI forecast, a little above 2% in 2014, so still kind of maintaining that level that's close to what our target would be, around 2%. On the other hand, you can look at what's happened with inflation, or unemployment, excuse me, and employment has continued to be a problem and a drag on the economy. We lost almost 9 million jobs during the Great Recession. We've gained back less than 6 million of those, and so it really has been a period of time where we continue to see high unemployment levels, and even though we've had quite a few gains in jobs over recent months, it's been bouncing up and down, and if you think of the last month, it was under 100,000 jobs created, and at the same time, the private sector has been doing relatively better than the government sector there. We've been shrinking the government sector in terms of the number of jobs still, so that's been holding back employment to some extent. Here you can see how the unemployment rate has been falling, and it's now under 8%, and in Iowa it's even lower than that, so that's a very positive thing for this state. But at the same time, it is only getting back down to the levels that were kind of peaks during earlier recessions. You can see here that it didn't even hit 8% in the 90-91 recession, and then it was even way lower than that, less than 6.5% during the most recent prior recession. So definitely hitting 10% during the Great Recession was a very big challenge for our economy and showed how many people had lost their jobs. And in order to be able to generate additional jobs, you need growth in the economy. And here you can see that we continue to have kind of fitful growth. We have some quarters that are stronger, other quarters where it's not so strong. And the last quarter was initially reported to be a negative, a decline in the fourth quarter of 2012, but then revisions have shown it's a little bit of an increase. But still, after such a dramatic downturn during the recession, we just haven't seen as strong of growth coming out of that as we would have anticipated. And when you decompose that growth that we are seeing, there's some interesting patterns here. Consumption has started to pick up, and it was about 1.3% of the growth last year, and residential investment 0.4%. So that was a big change from a couple years ago when that was a drag on the economy. Business investment has continued to provide some impetus to growth with 1.3%. And even net exports have been a positive recently. And there you do have some concerns with the global situation, but generally our exports have been growing enough that they've been lowering our trade situation in terms of how much we import versus export, so that's on net positive. But then the negatives from last quarter were the inventory drop, and that's something that's more variable, so it likely wouldn't remain a negative for too many quarters in a row, and it bounces back after inventories are depleted, and then they need to get rebuilt. But the government sector is the one where we have continued to see shrinkage, and the loss of jobs there is related to this as well. But just certainly, the government sector has been having to deal with a lot after the recession and the various tax policy changes and the whole idea of the fiscal cliff last year, that we had, some uncertainties that were built into the economy because of, the government situation. So here's a graph that shows how deep the recession was relative to a couple other recessions. So this recession was deeper because the drop from prior to the recession to the trough was more steep. And then it shows how weak the growth has been, only about 2% growth coming out of the recession this time, whereas previous deep recessions were much stronger, over 5% in the 81-82 period and the 74-75 period. So definitely much slower growth this time, and that's been holding back the U.S. economy in a lot of ways. And here are a couple of charts that give an indicator of part of the reason for that. Just the uncertainty that we've faced in this particular recession was much higher. We can see that previous recession went up about the same level, but then the uncertainty ebbed off, and we didn't have the policy problems that we've been faced with this time, where Congress and the President can't agree on changes. And so there's just a lot of uncertainty that's remained, and both in terms of the changes in our financial system after the financial crisis and all the other issues we're still trying to resolve going forward. But at the same time, on the right side, you can see that consumers' confidence fell dramatically during the latest recession, and it's regained some of its momentum, but it's not nearly as high as it was prior to the recession. So we still do have an issue with the confidence and uncertainty holding back the U.S. economy, although maybe not as much as late last year when we saw that poor quarter of growth. There have been some areas that are more positive in terms of people's confidence coming back. One is the stock markets. You look here and you can see that we've gotten the S&P 500 stock index back to the level it was at the previous peak, and there's some volatility around that peak now, but certainly it's a much more positive situation when we have the wealth that's generated from stock holdings and the income that comes from those as well in terms of dividends. And so that's something that's positive for the economy, that's helping to boost people's spending as they feel wealthier. On the other hand, we have the stock market, we have the housing market, and stocks are doing well. Housing market has come back some, but not nearly to those peak levels experienced in 2005, 2006, prior to the bust in housing. And you can see here just how far down the market went. It dropped about a third of its value, and so it really was a traumatic period for the housing industry, and it continues to be one of the sectors that has shrunk, but it is growing finally, and you can see that in terms of housing starts, we do see an increase in housing starts there in the last year and a half or so, and we're off that bottom, but we're still not to the levels we had prior to the recession, and actually the housing market was one of the things that led into the recession, where we had the deep downturn started and continued through the recession. So now interest rates are lower for housing. The home mortgage rate is under 4%, and that's very positive in terms of helping to give people an incentive to purchase homes, to be able to get them at a lower rate. The problem there, of course, is that we have many families that are still trying to get their household budgets in order, and they don't have down payments that are necessary. And we have had kind of a shift in the way that we handle mortgages now. Prior to the housing bust, there, certainly we had very loose standards in some ways, and it was maybe too easy for certain kinds of households to get mortgages and especially without documentation. So we do have a different environment today for the lending, and it is a positive thing in the sense that the standards are better, but we also do have a need for people to be able to qualify for those loans, and the federal government has instituted some programs and helping to deal with the foreclosures and over time also some of the other issues in the lending area. Another part of the economy that's starting to do well is the vehicle sales. When you look at the auto industry, there's been growth there over a number of quarters as people have used their cars long enough and they need to buy a new one, and we have started to see those pick up dramatically, and so that's quite a positive thing. Once again, low interest rates help people to purchase those vehicles, and that's something that's expanding the economic activity. And it really helps the Midwest, especially with Michigan and Indiana, even Illinois. Many of those areas have auto manufacturing facilities, so it's definitely been a positive from that perspective as well. And when you look at manufacturing overall, there's been quite a bit of improvement there. It was one of the things that helped coming out of the recession. That on the left chart here, you can see anything over 50 is showing growth in the manufacturing sector. And so there was some fairly strong growth coming out of the recession, and it's tailed off some since then, but still maintained growth. And one of the factors with that is that last year we did see a downturn in the orders for non-defense capital goods, excluding aircraft, and that's on the right chart there. You can see that it has bounced back up to kind of the levels prior to the downturn last year, but still somewhat below the highest peak levels prior to the recession and leading into the recession. So there's some room for improvement there still, but we do have growing manufacturing sector, and that's something that is a boost for the economy. One of the areas where this has been most positive is in the international sector. The manufacturers of the United States are very competitive worldwide, and one of the things that helps with that is that the dollar's value has been slowly shrinking over time. If you look at it a decade ago, it was much higher than it is today, and so the value of our products has increased in terms of the dollars we can get from other countries. So or in other currencies. So when you are looking to purchase manufactured products in the United States, you don't have to spend as much of the other currency to be able to buy them. And so it's been our goods are priced more competitively than they would have been a decade ago, and by the same token, our imports are a little more expensive. So U.S. consumers would tend to buy domestic somewhat more if the price points are similar. There have been a few incidents where we have seen flights to quality in the value of the dollar. Here you can see one during the financial crisis, and then another when the European Union was having their problems. So it's not just a downturn all the time, but at the same time, the value of the dollar still is important from the perspective that we are a reserve currency. Many other countries in the world have problems with inflation, and during those time periods you would tend to see the people wanting to hold on a currency like the dollar that has maintained its value a little better. And so here you can see the overall imports and exports, that they have been growing again after the downturn that accompanied the recession, and there has been some extra strength in exports, so that that area between the two shrank a little bit, and that's been one of the areas that's helped to boost the U.S. economy then. And in particular, when you look at agriculture, which is a part of the economy that I focus on a little more, you can see that there's been a surplus in agricultural exports. The exports have been rising quite rapidly, and we've been importing more as well, but it's not been keeping up quite as quickly, so we've had higher surpluses over the last few years, and expected again this year. So it's a positive sector with the income from getting boosted from agricultural exports. Farmers actually have had quite high net farm income the last few years. If you think about the drought again and how that impacted agriculture, you would have expected maybe a downturn in the amount of income in agriculture. But overall, it still maintained a very high level, and the USDA anticipates a very high level of income this year for agriculture. Only one other period in the last generation had a higher year, and that was back in the 1970s. So it's a little bit of a misnomer to think of the drought as a bad thing for agriculture, in the sense that we have a strong insurance program that helped to support the prices and to help give payments to the farmers that were hurting in terms of their crop production. But the side of agriculture that's been really struggling a bit more is livestock industry, when you have hogs and cattle that need to eat the inputs from corn and soybeans, and those are much higher, so feed costs rose dramatically, and the agricultural livestock producers really don't have the same kind of support net that the crop producers have. So they've been dealing a bit more with the issues related to the high corn and soybean prices. And part of the issue there, of course, is that yields were down quite a bit during the drought, so we had less available. The supplies still are kind of tight, but they aren't quite as tight as we had expected, and that has led to some decline in corn prices over the last month. At the same time, we would expect that this year we would start to see more of a trend increase in the corn and soybean yields and return after the drought. Now we have maybe too much water, and that's something that we're dealing with across the Midwest, and so that's helped to push the drought into the farther west. But at the same time, it is delaying planting. So whether we get as big a crop as we might have had, it's still hard to tell. But with the delayed planting, there could be some edge off the very top of the crop. But still, the anticipation would be to have a very large crop this year, which could lead to lower corn and soybean prices for the fall and into next year, which is when we might start to see some more issues with agriculture again, in terms of the dealing with lowered income levels. So this year looks pretty strong, given that we have crop insurance prices that are already set at the levels of February. So we wouldn't have a problem going into this harvest, it seems, even if we do have a bumper crop that lowers prices. And one of the factors that's been very positive for agriculture has been that farmland values continue to rise, and our Chicago Fed Ag Letter talks about this on a quarterly basis. You can see the increase here has been very high in nominal terms, but at the same time, when you adjust for inflation, we still have higher values for crop and agricultural land today than we had back in 1979-80 period, when we had a previous peak. And then we had a downturn in agricultural values, but over time those have been erased, and especially with the rapid increases of the last few years, double-digit increases have led to higher farmland values. And it's interesting to note when you think about kind of the nexus of food and healthcare, because really, there's a very strong relationship. When you are eating food that is healthy and nutritious, that's going to help ensure give you a better chance for a healthy lifestyle and a long life. And so when you think about what we spend as consumers, about 30% of that, or 30 cents on a dollar back in 1950, was on food. Today it's only about 15 cents on the dollar. So we are eating more, we're eating new kinds of food, we're eating better food in many ways than we were back in the 1950s, but we're only paying half what we had to back then as a percent of our consumption. On the other hand, we've seen our healthcare industry grow from smaller level to a very, to being larger than the food industry right now in terms of the percent of our spending. But you add those together, and they're still in that little bit above 30% range. So it's kind of interesting how we now have kind of this substitution in some ways along this spectrum, that you have issues where you have problems like obesity and other kind of nutritional situations where some of that food cost now has been transferred into the healthcare sector. but at the same time, we do have new products like functional foods. Yes, we have a question? We have a microphone for questions here, yeah.
Okay, so looking at your chart, you said 30, in 1950s, 30% of a dollar went for food. So how much went for health care there? Like 5 cents?
Yeah, it's a little over 5 cents maybe, yeah.
Okay, so, okay, that's what I was
Yeah,
after.
so it's kind of an interesting situation that, you know, they've added up to about the same level during that whole period. And so we have some amazing medical services, and I understand Iowa City has some great hospitals, so you're part of this medical phenomenon that we've had where we can have, you know, things that back in the 50s people thought were life-threatening that now, you know, it's just standard routine thing to get taken care of. And so it definitely is been a very big benefit to the U.S. economy in terms of making us healthier, live longer lives, and at the same time, some of those trade-offs in terms of the foods, that's something that we do continue to hear about. So definitely some strengths, and that's an area that we look forward to seeing. You know, there's of course lots of changes with the Affordable Care Act, so there is some transition in the healthcare industry that's ongoing. So now we've kind of looked over many different sectors of the economy and seen how there are a lot of positives for small business out there with low interest rates that we are trying to help push the economy forward. And I wanted to give you a little bit better understanding of why that is in terms of the theory and how it works in terms of our current plans at the Federal Reserve. So we're trying to balance aggregate demand and aggregate supply, that we want to kind of get things so they're working together in the economy and we don't have any imbalances. And what we've had over time has been aggregate demand has been much lower than aggregate supply, so then we ended up kind of out of balance. And one of the ways to help bring it back into balance is to lower interest rates. And so that could help increase our aggregate demand then, like especially in the housing and auto sectors, and at the same time give us a way that we can boost the economy over the short term and hopefully to get people moving ahead with their economic decisions, giving them an incentive to move forward. So when you think about those long-run interest rates in real terms, there's different components there. There's an expected short-term interest rate, and that's the one we often think about most when we see something posted about what interest rates are. But then we also have to subtract off the expected average inflation rate because that's eating into the value of our dollar. At the same time, we have to add back in some risk premia, whether it's for duration, credit, inflation uncertainty. So there's kind of that calculus that's going on about what we add and subtract to kind of get the real long-run interest rates. And there's two ways that we've been trying to affect these right now. One is through asset purchases to shrink term premia so that you don't have as much concern about the length of your holdings. At the other side is we want to give forward guidance that we're going to continue to have low expected short-term interest rates. One of the ways to do the asset purchases are that we would continue to purchase. Did I hit 2? No. So okay, so asset purchases help in terms of every month we're going to continue to buy these securities. That helps to lower the interest rates, and it's intended to shrink the duration premium of interest rates that when we have our purchases, we're taking some of the duration out of the market, and that helps to shrink the premium that is required for market risk. And that is also a signal that we're going to keep funds low for an extended period of time. So this is goal-oriented. We want to tie it to objectives and not just purchase securities for an additional period of time that is not set to a specific keystone in the economy. But we are calling these thresholds. They're economic thresholds that we would keep these interest rates low even after the economy starts to strengthen, just to make sure that there's enough impetus for it to keep moving forward. We wouldn't want to lower interest rates and then start to raise them too early is the basic idea there. And so keeping interest rates low until the unemployment rate falls below 6.5% is one of the things we want to follow. But on the other hand, if inflation started to pick up too much, say it gets over 2.5%, then we would need to take some action to avert having inflation get too high, because that would be also a problem in the economy. So we want to keep checking and to make sure that the economy is moving at a strong pace, strong enough to justify changing these thresholds and to changing policy. So this is intended to lower the expected average short-term interest rates and also risk premia for uncertainty and inflation. So there are definitely some new things that are being done in this policy. It was instituted last fall, and it's still has some newness to it that is we haven't done this before, so it will take some thinking in terms of how to reverse it and to pull out of this at a future time, but it's not anticipated to be in the next couple of years because interest rates are expected by the Federal Open Market Committee to remain low and especially the target rate, for the next 2 years, and then in 2015 we might start to see some of that rise in interest rates. So it's a period where we're using new tools and we're expanding our toolbox because the economy, the economic situation really demanded it. And that's why we're continuing to fight those high levels of unemployment with some of these newer tools. And here you can see now kind of how things look from the liability side. We had the asset side earlier that showed some of the special programs that were instituted, but the quantitative easing has primarily ended up being excess deposits, the red portion of this chart from the depository institutions. When you look at currency in circulation, that's growing, and that's what traditionally has been most of our liabilities, but now there are a lot of excess reserves because there haven't been the opportunities for banks, and the changing financial situation has required that banks shore up their own reserves, and so it's been a very interesting period for the supervisors and regulators of banking to deal with a lot of these issues and the new rules. But now we're hoping to see additional lending within small business and other kinds of opportunities that these excess reserves can go out into the economy and help expand it and to push the money supply forward. So when you look at the GDP forecast, then you can see that we anticipate, in line with the blue chip forecast, that we'll have the economy growing about trend this year and maybe a little above, and then even more above next year in 2014. Whether it hits 3% or not is a little uncertain, but it's edging up in that direction, definitely. Now, the kind of biggest negative that's in the picture right now is the federal government situation, and that's something that you can see from this chart has been an issue for a few years, that during the recession the expenditures of the government rose quite rapidly and hit levels that we didn't see prior as a percent of GDP in the post-World War II period. World War II is the only other time we had the percent hit 25% or higher. So definitely still high levels of expenditures, even though they've been coming down some. And receipts for the government have been relatively stable, in the long term, but up and down in the shorter term, obviously. And those are still needing to come in line a little more in order to keep the debt from growing too much in terms of its share of the gross domestic product. And if you think about the federal debt on a per capita basis, in real terms, that is adjusted for inflation, it's nearly $53,000 per person now. So there has been some dramatic increase there that is overhang in terms of the future growth in the economy. But at the same time, it's not to the point that it's out of hand yet. We can make some decisions and come to some long-term conclusions that we could, work on this and decrease it over time and in terms of the size in the economy. And so there is some hope that we can come up with a program that would be able to do this. At the same time, it is something that's overhanging small business, that we do have this kind of debt that we need to be concerned about in the long run, especially. Not so much in the short run, but the other side is also the healthcare industry, I think, continues to be, I mentioned that earlier, and there's a lot of uncertainty about expanding a small business past 50 workers and what the implications for that will be in the bottom line in providing healthcare. And so there's still some issues to be worked out there. But I think generally the entrepreneurs in the U.S. are able to take advantage of the economic conditions and be able to establish new businesses that can help grow the economy and to give us innovations and new ideas, new products that we want, that we see these in many different activities. And it looks like around this area there's been a lot of redevelopment in Iowa City with new companies coming in and providing services and the goods that people desire. So that's going to help wealth creation. It's helping generate new activity in the economy, and expanding the economy is definitely a very positive thing. And Iowa and the Midwest in general have an advantage here, I think, because we have our agricultural tradition where farmers and farm families have often been involved with coming up with new ideas and generating new products and meeting the needs. And we see this a lot in the local food movement even, where you have people starting up small farms that are able to provide food for farmers markets and other value-added ideas. So we still have a lot of this kind of business formation expansion where people are able to generate new income from good ideas and new products, and that's something that's very positive. But at the same time, we do have issues with trying to get a regional cooperative effort going. We need to be moving ahead and have partnerships beyond just the bounds of our own small communities. And oftentimes you can see that in kind of like the corridor here. You have Cedar Rapids and Iowa City trying to work together to have an area where we can have enough of a mass of businesses in the information era that you can really get to having that. And I lost my screen here. You still see it there? Okay. Yep. So we have positives for growth. We have a lot that's looking up in the economy. We do have a lot of unused resources that are ready to be brought back in, and when you see that in the unemployment rate that still is elevated, and a lot of long-term unemployment, that is one of those factors that is a concern. But at the same time, we have the housing market that's healing. We have manufacturing continue to grow, and we have a lot of firms with funds available to invest. And so there's accommodative monetary policy that is providing the ability for additional growth as well. Now, on the government side, some of the states and local sectors are doing better. They've gotten their financial house in shape, and Iowa's in that boat. Obviously, Illinois, you might have heard, is not necessarily doing as well, but generally, I think the state level and local level is improving at this point. But the federal fiscal consolidation is ongoing. There's a lot of issues there with the sequestration, that is a bit of a drag on growth this year. But the longer term issues are also kind of something that need to be addressed before too many years go by. And of course, you also have a slower global growth and some issues there with the European Union possibly in a recession, and the fact that other countries like China have slowed their growth to some extent. So there are some things that might hold us back this year, but at the same time that we have those problems, we have many areas that are moving forward, and it seems like the positives should weigh in, and we should have higher growth by the end of the year and into next year. So that's where we expect the economy to grow, is above trend into next year, and then expectations would be that unemployment would start to fall even further. But there is that slack in the economy, so inflation should not be taking off at this time. And agriculture has been healthy, but it'll face some more volatility as we go forward. And agriculture, is a key component in Iowa, and it's going to continue to be, I think, a healthy part of the economy here. And finally, housing has turned a corner. It's still got a long ways to go, but generally, it's one of the sectors that's going to help us move forward. And so that's kind of my quick summary on maybe what didn't seem so quick to you, but I'm happy to take any questions and to be available afterwards.
I have a question too. Thank you very much for your presentation. I listen to a lot of financial news. I guess I just listen to a lot of news, and I'd heard a report, and a couple of reports actually, about the return to the United States of manufacturing that had left, and how that was good. I mean, it was a positive for the economies of those areas, but one of the downsides of that was that they said that the plants were expanding and reopening, but the wages were much less than they had been in the previous times when the unions were really strong. Can you talk about that at all?
I can address that a little. It's a very interesting dynamic that we have in the manufacturing sector, because we had jobs go overseas to places like Mexico and China, and there have been jobs coming back. It's really a story of labor substitution in some parts, because what you can do now is to buy a piece of capital equipment that maybe takes away a few jobs, but at the same time, for the whole overall, for the U.S. economy, it's, we're benefiting, because it's not just the piece of equipment that you're adding, but it's also the servicing of that equipment. It's also the design of those, capital equipment. And so it's not a simple story. There's many facets to it, that some of those jobs are higher paying jobs. Some might be not as high paying jobs, but assembly line kind of work is changing. You have to have higher skills, and if you have had the training and are able to use some of the newer equipment, those jobs are very valuable, very well paid relative to the others, I believe. But at the same time, there's a lot of workers that aren't qualified for those, and so manufacturers are actually looking for workers in some areas, and they have other workers over here that aren't able to necessarily fill some of those jobs, and they are still unemployed. So it is an interesting dynamic. Some of the research has indicated that wages in China are rising fast enough that now many companies will go and bring jobs back to the U.S. possibly, because their supply lines are more their logistics are better here, and then others are going to places like Mexico, where they still are connected through the North American Free Trade Agreement to the United States, and you don't have to worry about shipping as far. But still, it is a interesting dynamic, and it's different within some different kinds of manufacturing as well. Another question?
Sure. You mentioned agriculture, and we were talking about land prices. Do you see the farm prices decreasing at all? Do you see them stabilizing? Do you think it's a bubble? How do you think it will impact? We talked about agriculture as entrepreneurship. What do you look at the 5-10-year plan given farm prices right now? And then I have another question, too.
Okay. Well, we'll answer that one first. The agricultural land values are at very high levels right now. They've been rising rapidly, and I wouldn't anticipate that to continue. But at the same time, I don't think there's going to be a huge drop-off in the near term. There's still some support there in terms of the very high incomes. So farmers have been buying land without having to buy it, use a lot of debt to finance it. And so if there were a need for them to sell it, they wouldn't get into a big problem in terms of their own finances maybe. They would, so there is that kind of a issue that, the debt situation is not like it was back in the 1980s when we had the last farm downturn, and it is a better from that perspective. However, I guess the other part of what you're talking about is just that land values really are supported by that expected stream of income that the land can generate. And there, the productivity has been a big factor, that we are able to produce so much more from a given acre of land in terms of the bushels of soybeans or corn. And so the productivity has been one big factor, and then high prices in recent years for corn and soybeans have helped to generate extra income. And when those fall, that'll take out the growth, it seems, this year that's likely to happen. But at the same time, in the longer term, there's still a positive story to tell, and farmland is going to continue to be a very valuable thing because we have growing needs for food around the world, and there's only so much land that can grow food that's available, and certainly other parts of the world will expand as they're able, but there's water constraints in much of the world as well, and so we will continue to see, I think, in the long term, 5 to 10 years, that farmland continues to have a high value for U.S. agriculture. Gives us a good competitive advantage. And did you have another question?
I did. The other question is that there's a quarterly downturn in inventory, but then you did see some expansion in plants. So I'm wondering how the two correlate, and I maybe am reading way too much into it. So I'm just wondering if there is some kind of correlation with that.
Well, I haven't looked carefully at that correlation, but certainly there is kind of a feedback mechanism. So when your inventories are high, you kind of cut back on how much you're producing. So you would tend to slow down. So we have seen some slowdown in manufacturing. But then when your inventories get low, you have to start to produce a little more again to fill them up again. So because you always have to inventories are designed to be able to help the transition of goods and services from one part of the economy to the other, kind of from the production phase into the consumption phase. And so it is really kind of a balancing act, and firms can't always predict, if they could predict 100% what the demand for their product was, it'd make it a lot easier. They wouldn't need as much inventory, and certainly the new kinds of approaches to inventories, what you might have heard of as just-in-time inventories, are very important in lowering the levels of those inventories so they don't need to have as much on stock at any one time, because they're better able to anticipate what the demand for certain products or certain products will be. So there is kind of that up and down, nature to inventories as a part of our economy. Another question, or? All right. Well, thank you very much.
Thank you very much, Dave. That was a very illuminating discussion and much more positive than I had wondered how it would be. So thank you all for coming to our first program in Money Smart 2013. And we have another program tomorrow at noon, and it will help you after you've got this foundation on small businesses. It will be a program on budgeting, and we look forward to that. So thank you all. Have a great afternoon.